The Federal Reserve did exactly what everybody expected them to do. They raised the Fed funds rate by 25 basis points, but the economy is not only going to weaken, but weaken much more than the markets expect. So the markets may in fact be right that the Fed stops hiking, but not because inflation comes down, but because the economy comes down. The Federal Reserve did exactly what everybody expected them to do. They raised the Fed funds rate by 25 basis points. We're now at 4.5 to 4.75. That is the range that the Fed targets. And the reason the Fed raised by 25 basis points is because that's exactly what everybody expected. And the Fed doesn't want to do anything that the markets don't expect. It pretty much delivers whatever is expected. But apparently what wasn't expected is that Powell was not as hawkish as some people had feared. In fact, before we got the news of the rate hike, the Dow Jones was down about 300 points. And then after we got the news, there was a bit of a knee-jerk rally, but then the Dow Jones fell and hit new lows, and at one point was down over 400 points. In fact, it was down 400 points with less than a minute to go in his prepared remarks. But when he began to wrap up his remarks and he didn't drop any hawkish bombshells on the market, you got an immediate rally. And by the time he stopped speaking, less than a minute later, the Dow was only down about 250. But then as the press conference came to an end, the Dow had a big rally. At one point, the Dow was up better than 200 points. But by the close, it was barely in the black. The Dow Jones up about 7 points on the day, but a much bigger move in the NASDAQ. It was up 2 full percent. In fact, the Cathie Wood ARK Innovation ETF did even better, up 4.4%. In fact, the NASDAQ is continuing its rally after hours. It's up another 1% on the back of better than expected earnings out of Meta, which used to be Facebook. That stock is up better than 20% as a result of those earnings. Although I think more important than the earnings was the massive $40 billion stock buyback that they also announced. But I think what's more significant about the short covering rally that continues in tech stocks and the fact that people are trying to play this bounce by buying the most beaten down assets from 2023. Some of the meme stocks are rallying. Bitcoin spiked again. It's getting close to 24,000. But I think the most significant action is in the foreign exchange markets and in the gold market. The dollar tanked. The dollar index fell a full percentage point. We almost cracked the 101 handle. We closed at 101.08. This is a new low for the year. In fact, this is the lowest the dollar index has traded since April of last year. As the dollar went down, gold went up. We closed just above $1,950 an ounce. This is also a new high on the year for gold, and it's the highest price gold has traded again since April of last year. We also had a rise in bonds, a fall in bond yields. In fact, the yield on the 10-year is now back below 3.4, and the yield on the 30-year is below 3.5.5. I think traders are looking at the softening economic data and the pullback in some of the inflation measures that we've had in recent months, and they think that the Fed is either done hiking now, even though Powell indicated that a couple of more hikes are coming. But again, these are 25 basis point hikes. So maybe at the most, the Fed is talking about bringing rates up to 5.25, maybe 5.5 max. But I think the markets believe that the Fed may not in fact get that high because they believe, A, the economy is weakening probably more than the Fed acknowledges, but also they believe that inflation is going to be coming down even faster than the Fed pretends. But the reality is inflation is not going to weaken, it's going to strengthen. But the economy is not only going to weaken, but weaken much more than the markets expect. So the markets may in fact be right that the Fed stops hiking, but not because inflation comes down, but because the economy comes down, or because employment comes down and unemployment goes up. But as of now, everybody thinks everything is great. It's a Goldilocks scenario. People are looking for a soft landing where the economy weakens just enough to bring down inflation, but not enough to bring down corporate earnings, and you're getting this rally in everything. But it's important to differentiate between the rallies that are sustainable and those that are not. For example, I believe the rally in gold is not only sustainable, but it will accelerate. But what we're seeing in tech stocks, for example, or cryptocurrencies is not sustainable. These are head fakes, dead cat bounces, and at some point soon, I think we're going to see a reversal as markets become very disappointed in that reality doesn't match their fantasy, especially when it comes to inflation. In fact, one of the keys to why inflation is going to be so much stronger than people think is because the dollar is going to be so much weaker than everybody thinks, because the weakness in the dollar is what's going to be the catalyst for another explosive move up in commodity prices. And it's the decline in commodity prices that is helping to keep down goods prices, which is why everybody is so convinced that we've seen the worst of inflation and it's headed lower. But as commodities start to make new highs, when the dollar makes new lows, that's going to throw cold water on that theory, and people are once again going to be afraid of higher inflation. But I think the Fed is going to be afraid to fight it because it's afraid of what that fight might do to a much weaker economy and much weaker labor market than what the Fed now expects. But now I want to focus specifically on some of the things that Powell said, first during his prepared remarks and then during the Q&A that followed. First of all, Powell immediately acknowledged the hardship that inflation is causing Americans. Now, because the real cause of inflation is the U.S. government and the Federal Reserve acting in concert with one another, where the U.S. government spends money it doesn't have, and then the Fed prints the money for the government to spend, that is why we have inflation. So if inflation is causing an economic hardship, and if the government and the Fed cause inflation, then it's the government and the Federal Reserve that are responsible for that hardship. Of course, Powell will never accept responsibility for the pain that he is helping to inflict, but it's the Fed and the government that are the reason that so many Americans are suffering this hardship. Inflation is a tax. It is how we are paying for government. And so if funding government is creating a hardship for the people who are on the hook for the tab, well, it's the government that's to blame. Then Powell said that the Fed's responsibility was price stability, and it takes that responsibility seriously. Powell claimed that price stability is the bedrock of our economy, and so it's very important that we have price stability. Now, if that is true, why does the Fed insist on 2% inflation? Because price stability means no inflation. Stable prices don't go up every year by 2%. Stable prices remain the same. That's what stability means. There's no change. Things are stable. Powell doesn't want stable prices. He wants prices to go up 2% a year, and he wants to pretend that a steady 2% annual increase constitutes stability. It does not. But also, if Powell thinks that price stability as defined by 2% inflation is so important, why is his goal simply to bring inflation back to 2%? After all, we've had so many years now where inflation is way above 2%. Why wouldn't Powell be targeting a lower rate of inflation than 2%, or maybe even falling prices? Because if we want to get the average rate of inflation down to 2%, given how much inflation we had in 2021, 2022, how much we're on track to get in 2023, in order to bring the average back down to 2%, we need to have some years where it's way below 2%. In fact, it would really help if we had some years where prices fell. That would be a big relief. But for some reason, Powell is against that. He doesn't want to reverse any of the price increases. He just wants to make sure that price increases continue just at a slower rate than the rate that they've been rising in the past. So in other words, if you think prices are too high, expect no relief from the Fed. all the Fed is going to do is increase them at a slower rate. But of course, it's not even going to accomplish that. In reality, the rate's going to increase. Now, Powell mentioned in his prepared remarks that the Fed has made progress on inflation, but it indicated that it has more to be done, that the job is not finished, and that it would be premature for the Fed to declare victory, and so further rate hikes are appropriate, and presumably those quarter-point rate hikes are coming over the next couple of Fed meetings. But in reality, the Fed has made no progress in the fight against inflation. Sure, we have seen this temporary reduction in the rate of increase in prices, but it's only temporary, because in order to really make progress on inflation fighting, Powell would have to change consumer behavior. We would have to have an increase in personal savings and a decrease in consumption spending. We're not seeing that at all. Credit card debt is at an all-time high. Savings are at an all-time low. Households are spending everything they earn and then some. And then, of course, you have all this government spending. So we haven't made any real progress in fighting inflation. It only appears that way if you're focusing on the effects of inflation, which are prices, rather than inflation itself, which is the expansion of the supply of money and credit, and that continues. Even if money supply growth has slowed, credit growth has not. Powell did mention that job growth continues to be robust. He continues to believe that we have a strong economy, and he's happy that the improvement in inflation has been able to happen without imposing significant restraints on economic growth or employment, but he acknowledged that that's likely to happen.